This is a companion video to the video on the Polaris website on the valuation app worksheet, Discounted Cash Flows. In this video, we'll be discussing the evolution of valuation, particularly theory to practice. It's brought to you by PolarisInvesting.com, a site for creating defensible valuation. Recall, business valuation is based on expectations derived from skillful consideration of past facts and future possibilities. Scrolling over to the right here on the worksheet, you see a brief write-up of the current state of valuation. Analysts use discounted cash flow models that focus on economic return, namely return on invested capital. Yet they often communicate to retail investors using accounting terms of EPS growth and PE ratios. Analysts essentially translate discounted cash flow output into PE language. So next, going to discuss how valuation got to this point by reviewing the evolution of valuation from theory to practice. As we go through the evolution of valuation, keep in mind that in theory, value is the present value of cash flows. They can be taken out of the business without impacting future returns. It is a single exact value. But in practice, value is a range that you feel confident enough in to take action. To better understand the gap between theory and practice, going to cover the origin of the subject of finance, and then discuss pillars of theoretical finance, financial modeling, and then practical suggestions for valuation. Previous to the 1700s, economics was part of political philosophy. As long ago as 350 BC, philosophers like Aristotle from Greece treated questions of exchange, property, and wealth and political questions. There was no separate discipline of economics. That changed around 1776 with the publishing of the book Wealth of Nations by Adam Smith. Smith himself was a professor of moral philosophy, and the book was conceived as part of a broader philosophical discussion, but his systematic treatment of markets, labor, and capital laid the groundwork for the distinct field of economics. The word economics comes from ancient Greek and means household management. Economics quickly gained mathematical rigor, but at the expense of the human element. More recently, a new branch of economics called behavioral economics is pulling economics back towards its social roots. Economics is a social science. Theories are inferred from observation. Economics is a study of constrained resource allocation. Finance was spawned from economics, but up to the early 1950s, finance was largely treated as applied economics, or a subset of business administration. It was focused on how corporations raised money, accounting practices, and banking. There was really little rigorous theory. Math quickly rushed in to fill the void. It has now created what can be considered a logical social science called finance. The word finance comes from Latin and literally means bringing an obligation to an end, as in a final payment. Today, finance is considered to be a study of financial decision-making under uncertainty. Finance is a messy discipline with some mathematical precision, but also includes fallible human elements. Finance can be considered less a science than a faith. In finance, you are discovering temporal truths of God's children who value assets based on their constant changing opinions. It is important to keep in mind finance remains an inexact social science where prices are based on future expectations, realized or not. Interesting to note that today, most universities separate finance departments within business schools, distinct from the economics department, which still sit in the arts and sciences. Okay, next we're going to discuss some significant developments in the theory of finance. Starting off here with Jacob Bernoulli in the early 1700s came up with the concept of continuous compounding, particularly the constant E. By the way, Jacob Bernoulli is the uncle of Daniel Bernoulli, who is well known for his work in statistics. Later in the 1700s, you had Edward Haley, who did work on present value and specifically with annuities and bond coupons. By the way, Edward Haley is the same Haley that Haley's Comet is named after. Although not a finance theory, a notable event took place in the late 1700s, namely the Buttonwood Agreement. It involved 24 merchants and stock operators who routinely met under an old buttonwood sycamore tree on Wall Street between William and Pearl Street in Lower Manhattan. They signed a 2-sentence contract agreeing to only trade amongst themselves and to uniformly charge 0.25 percentage point to others to trade on their behalf. The agreement essentially was the birth of organized securities trading in the United States. Before the agreement, trading was haphazard and was conducted at coffee houses with real no no standards. The signers eventually moved indoors in 1817 and later became known as the New York Stock Exchange. None of the 24 signers of the agreement are well-known historical figures. They were business practitioners of the day that came together out of a common need. As we discuss financial theories, keep these men in mind and how they traded based on their opinions derived from years of experience and what they might think about the current quantitative nature of financial markets. Over 100 years after the forming of the New York Stock Exchange, a more rigorous approach to financial markets began to emerge, led by Irving Fisher, an economist from Yale. Fisher was the first celebrity economist. He helped create the Federal Reserve in 1913. He also established finance as a separate discipline from economics and firmly established the concept of discounted cash flows. He argued that the most recent stock market crash in 1907 showed the need for the central management of the money supply. Fisher became convinced he had helped tame the extremes of the stock market. The stock market ballooned sixfold during the 1920s, indeed the Roaring Twenties. Personally, he amassed a wealth of over $150 million in today's dollars by 1929. 9 days before the stock market crash of late 1929, he arrogantly stated in a newsreel that stocks have reached a permanently high plateau. Unfortunately, Irving did not practice what he preached. He was totally invested in his card filing company. Its stock plummeted from $58 a share to $1 within weeks. Yale graciously purchased his home, and he borrowed money from his rich sister-in-law. He lived his remaining years renting his home from Yale until his death in 1947 at the age of 80. After the crash of 1929 and the ensuing depression, a whole generation became very distrustful of Wall Street. Investors entrenched on the relative safety of bonds. Life insurance became the preferred way to save. During this period, men often worked until their death. Insurance was viewed as a way to provide spouses with a guaranteed income. Academia continued to do a post-mortem on the stock market crash. During this time, there were notable contributions to finance that included Robert Weiss, Samuel Eliot Gill, Frederick Macaulay, John Burr Williams, and Benjamin Graham. Benjamin Graham's book, Security Analysis, is a composite of his class notes from his night class at Columbia on security analysis that he taught from 1928 to 1956. His book, Security Analysis, has sold over 1 million copies since its initial release in 1934, which is very unusual considering it is essentially a college textbook. Graham became known as the father of value investing. His star student, Warren Buffett, continues to promote his teachings of value versus price, concept of Mr. Market, investment versus speculation, the need for a moat or durable competitive advantage, investing with a margin of safety, and doing financial statement analysis, basically evidence-based investing. Graham's cautious approach to investing likely stemmed from losing both his father and grandfather within months of each other at the age of 9, which thrusted his family into hard times. In 1928, at the age of 34, having benefited from the Roaring Twenties, had an annual income of over $60,000, equivalent to $7 million today. Graham personally lost over 70% of his wealth between 1929 and 1932, ending his lavish lifestyle. Using the investment techniques that he taught, his fund recovered, returning almost 18% on average annually from 1936 to its eventual closing in 1956. Having lived a lavish lifestyle before the Depression, he realized he was happier when he lived a more modest way, so he was careful not to return to that previous lifestyle. Even though Graham's value investing stresses prudent, disciplined investing, his personal life was tumultuous. Through the 1930s and 40s, Graham wrote 3 plays and even a vaudeville sketch. Likely from his exposure to the entertainment culture, he had several casual relationships. In 1934, Graham had his 5th and last child with his first wife, divorcing her in 1937. The 5th child was named Newton, the same name as an earlier child that died at age 8. In 1954, at the age of 26, the 2nd Newton committed suicide while serving in the military in France during the Korean War. While in France to sort out his son's affairs, Graham met his deceased son's companion, Malou, who was in her 40s, 15 years older than his son, 20 years younger than Graham. Graham started a relationship with Malou, lasting till his death in 1976. He remained legally married to his 3rd wife, who he had a son with named Benjamin. He also had a very brief second marriage with an actress in the late 1930s. The reason for going into the personal lives of Irving Fisher and now Benjamin Graham to show that even those who teach very rational approaches to investing investing were very human. They knew firsthand the difficulties of staying unemotional when investing. The next major wave of advancement in financial theories occurred in the late 1950s and into the 60s. Myron Gordon developed the well-known dividend growth model for valuing stocks. Franco Modigliani and Burton Miller wrote a seminal paper on the cost of capital as young professors at Carnegie Mellon. Trained as economists, they felt the finance field was lacking in academic rigor. When asked to prepare to teach for the first time a managerial finance class, their story reflects the power of consilience. They had little finance background to restrict their thinking. Their propositions applied to capital budgeting revolutionized the practice of finance by separating the finance decision from the investing decision. Valuation became an exercise in discounting expected after-tax cash flows at a weighted average cost of capital. Around this same time, Burton Malkiel, an economist from Princeton, proposed limiting the number of years to forecast cash flows and then adding a terminal value, also known as continuing value. This was a practical way to handle forecasts that extended far into the future and made calculating stock valuations similar to calculating a bond price. Namely, value is present value return on investment plus the return of investment. Interesting to note that several years later he wrote a book called Random Walk Down Wall Street, in which he argued that it's impossible to accurately value an individual stock, and that investors are better off owning an index of the overall market. Notice also who wrote the foreword to the book, Paul Samuelson. We'll be coming back to him shortly. The next major wave of advancement in financial theories occurred in the mid-1980s and into the 90s. These advancements primarily had to do with defining economic flows of cash, namely free cash flow to the firm and free cash flow to the equity holder. Return on invested capital and reinvestment drive value, not earnings growth, and PE ratios. Aswath Damodaran from the New York University is currently considered the dean of valuation. Damodaran advocates a two-stage discounted cash flow model, formula shown on the right. The formula provides sufficient enough detail without getting bogged down in minutiae. In this model, free cash flow to the firm is forecasted for each year of stage 1 to compute an average growth in net operating income after taxes, also known as net operating profit after taxes or NOPAT. The stage 1 average growth is used to compute an equivalent starting high growth that gradually declines to the stage 2 forecasted growth. This approach of gradually declining growth in stage 1 is called the H model. Note, you could start off with high growth and compute the average growth implied through stage 1. In stage 2, a stable growth rate is forecasted to compute a terminal value as proposed by Burton Malkiel. Since this video was originally recorded, the following has been added to discuss terminal value in more detail. The stage 2 discounted cash flow model is often criticized for having the majority of its value derived from the terminal value, and it is very sensitive to model inputs, making it easy to manipulate. Curtis Jensen, chief investment officer at Third Avenue Bank, said, "Discounted cash flow is like looking through the Hubble telescope. Move it a bit and you end up looking at an entirely different galaxy." Burton Malkiel, author of the book Random Walk, said there is an inherent indeterminateness in valuation. God Almighty does not know the proper price earnings multiple for a common stock. Aswath Damodaran's rebuttal is terminal value dominance is not a flaw, but an acknowledgement that companies are long-lived going concerns. Terminal value captures the long-term capital appreciation. He dismisses manipulation as bad use of the model. He points out that a significant impact on stage 2 is the net operating income after taxes coming out of stage 1. Thus, stage 2 dominance is a reflection of stage 1. The main inputs to terminal value are growth and return on invested capital and cannot be set freely. They are constrained. Discounted cash flow model forces you to be explicit about these few significant inputs. For most companies, stage 2 growth cannot exceed the growth of the economy, which in the long term is similar to the risk-free rate. Because of intense competitive pressure, the return on invested capital converges to the weighted average cost of capital, which implies no company can sustain abnormal returns indefinitely. Competitive forces cause all companies in the long term to earn an average market expected rate of return on investments based on the company's business risk. Growth is not free. It requires reinvestment. Growth is equal to reinvestment times return on invested capital. The chart in the bottom right shows how growth is a function of return and reinvestment. For further discussion on this chart, see the video Concepts Multi-Stage Approximation. Around the 6-minute mark, or the video valuation calculation future PE multiple around the 18-minute and 30-second mark. Analysis often inadvertently manipulate discounted cash flow by setting growth and reinvestment independently, assuming a growth rate with inconsistent reinvestment. Reinvestment is difficult to determine. As stated by Bill Nygren from Oakmont Funds, analysis gets real fuzzy when it comes to how much capital will be needed to support future growth. When input value constraints are properly incorporated, the terminal value is determined by weighted average cost of capital and the long-term growth of the economy. Reinvestment is not an independent variable. It is derived from the return on invested capital and growth inputs. Terminal value calculation in the two-stage discounted cash flow formula assumes companies' growth eventually reverts to a sustainable level. But a more pragmatic interpretation is it is the average growth over numerous secular periods, as shown in the graph to the left. Markets incessantly swing to extremes with impact of periods far into the future significantly dampened by discount. To demonstrate the dampening effects of discounting, I'm going to now look at the spreadsheet used to generate the graph. For a detailed discussion on the spreadsheet, see the video Concepts Multi-Stage Approximation. Notice the graph in the second 5-year span in stage 2 is relatively small, growth of 1.4%, whereas the third 5-year span is much larger of 6.5%. The average across all the spans is 2.8%, and the cumulative valuation for all the spans is $32.71. Now let's switch the relative high growth of 6.5% with 2.8%. The average across all spans is still 2.8%. The cumulative valuation for all spans only slightly increases to $33.71 as a result of bringing the higher growth rate forward in time. The valuation remains similar to the two-stage valuation of $32.65. Because of the dampening effects of discount, the order of assumed growth rates has limited impact on valuation, especially far into the future. Okay, back to the original video. Two-stage free cash flow to the firm formula computes the enterprise value. Equity value is then computed by subtracting the current market value of debt and adding cash. The two-stage free cash flow of the firm model incorporates the cumulative thinking about valuation. Notice the denominator includes the weighted average cost of capital, which is from Modigliani and Miller. The weighted average cost of capital includes the cost of equity, which is derived from the capital asset pricing model, which is from William Sharpe and is built on the ideas of Harry Markowitz. The numerator includes the return on invested capital and reinvestment, which is growth divided by return on invested capital. This formula shows the main drivers: return on invested capital and weighted average cost of capital. If the return on invested capital is greater than the weighted average cost of capital, value is being created. If the return on invested capital is less than the weighted average cost of capital, value is being destroyed. Up till now, we have covered the major developments around discounted cash flow analysis and value investing. But there are numerous other financial theories, many of which rely on advanced mathematics. Financial theories have split into the value camp and advanced math/physics inspired camp of quantitative finance. The epicenter of the value camp is Columbia and New York University. The epicenter of quantitative finance is MIT and the University of Chicago. Quantitative finance has a serendipitous history. In the early 1960s, a University of Chicago professor named Leonard Savage was perusing books in the library and stumbled upon the book Probability Theory Applied to the Stock Market by Louis Bachelet. The book was written in the early 1900s. Savage mentioned his discovery to Paul Samuelson, an economics professor at MIT. Samuelson then discovered Bachelet's 1901 doctorate dissertation titled Theory of Speculation. In his dissertation, Bachelet drew an analogy between diffusion of heat and how bond prices wander up and down. Heat diffusion equations were developed by Baptiste Joseph Fourier in the late 1700s. In the 1800s, a Scottish botanist named Robert Brown applied similar equations to movement of pollen grains on water, and this type of movement has become known as Brownian motion or Gaussian/normal distribution. When details are just too messy and complicated, it is best to back away and treat as a black box and use probability to describe the system. Some have gone so far to state Bachelet is to finance as Einstein is to physics. But unlike Einstein, Bachelet's work was discovered posthumously and was incomplete. For example, he incorrectly concluded that prices are normally distributed. This is nonsensical because this implies prices could be negative. This has been revised to that returns are normally distributed, not prices. Personally, I find it a stretch to think future events that affect a stock's price are completely independent and returns are always normally distributed. Notable contributors, many of whom earned Nobel Prizes in the field of quantitative finance, include Milton Friedman, Eugene Fama, James Tobin, Harry Markowitz, William Sharp, Fisher Black, Myron Scholes, and Robert Merton. Harry Markowitz expanded on Bachelet's idea of stock returns being normally distributed. He asserted that all stocks can be characterized by just two statistical measures, the returns mean and its volatility or variance. The graph in the lower left shows that as the stock price falls below its valuation, the mean return goes up, but the expected dispersion or variance of the return is the same whether the current price is considered above or below the valuation. Black, Scholes, and Burton used Markowitz mean variance to develop the acclaimed options pricing formula shown below. As this formula demonstrates, the mathematics used in valuing financial assets has come a long way since the Buttonwood Agreement in 1792. Yet investing remains at its basics, a social phenomenon dependent on the frailty of human judgment. This frailty was on full display yet again in the 1990s. This time it included the developers of the option pricing formula, namely Harvard's Robert Merton and MIT's Myron Scholes. To give credibility, they were hired by Long-Term Capital Management in 1994. Long-term capital management envisioned markets as stable systems in which prices moved about a central point of rational equilibrium. Merton and Scholes calculated odds to precise mathematical degree. To them, investing was less about art, requiring human judgment, than it was a science that could be exactly quantified. Risk to them was an innate trait. It was a function of historic price volatility. Long-term capital management attempted to make minuscule profit on bond interest rate spreads and multiply those bets by leveraging its capital. They borrowed by selling high-demand, lower interest rate bonds short and bought lower-demand, higher interest rate bonds long. They bet that global interest rate relationships would revert to their historical mean. The bet was essentially that the future would eventually look like the past. Within 2 years of operation, long-term capital management's leverage climbed from 30 to 1, eventually reaching 100 to 1. At the end of 1997, after several years of success, their bets began to dramatically sour. Pressured by their outside investors for changes, they bought them out and proceeded to lose all the partners' investments in 1998. In the summer of that year, Russia defaulted on its bonds. Long-term capital management rolled the dice and arrogantly bought more Russian bonds. Within 5 weeks, they had lost their entire capital of $3.6 billion. Long-term capital management collapsed in October of 1998. They were taken over by 14 banks who each invested $300 million. Long-term capital management failed to model extremes. They did not take into account the herd behavior of human beings. Then in a crisis, correlation of most asset types tend towards one. Scholes and Merton, with their reputations significantly tarnished, retreated to the shelter of academic life. Unfortunately, the stories like long-term capital management persist. Humans have dramatically modified their habitat, but are still operating with mental wiring designed for much earlier ages. Thinking shortcuts that enable a faster response are now a liability. The following biases are particularly impactful to investors. Presentism bias, which means give more weight to recent events. Availability heuristic, where vivid memories are more readily recalled. Framing bias means you can be easily swayed by storytelling. Confirmation bias means seeking confirming information, essentially an echo chamber, which social media has compounded. Information overload, which often results in haphazard filtering. And then overconfidence, thinking you have unique insights, often from just a lack of timely feedback. To deal with human biases, many investment actions need to be automated through the thoughtful design of financial models. Unfortunately, many models exacerbate the problem. The following are some observations about modeling, of which I'll point out a few. Complexity adds uncertainty. Complex financial universe resists formulaic solutions, and markets are about the foibles of human beings, thus very difficult to reduce to mathematical formulas. The stock market is inherently imprecise and uncertain. Investors must tear off the shackles of certainty in order to pursue the best opportunity. The aim of human judgment is not perfection, but overcoming paralyzing uncertainty. Anything more than simple algebra is substituting arcane theory for experience. Models splinter upon closer inspection. Financial models result in spurious accuracy, have extreme input sensitivity. Precise formulas with imprecise inputs can be used to justify any valuation. The best models have limited explicit assumptions about a few variables. Important to know the model's limitations. An investor mired in market minutiae is doomed. Models best thought of as a way to explore a framework for decision-making under uncertainty. A purely model-driven decision process is relatively easy to imitate. Differentiated skill is in the use of the model. When doing valuations, there are some rather harsh realities. Namely, stocks are stories and bonds are mathematics. Valuation is an opinion, not a discoverable fact. Exact value is unknowable. Valuation at best is a range, ballpark estimate for many possible futures. Valuation best used to determine when prices have become extremely untethered from fundamentals. And lastly, it's not the valuation itself that matters. It's the degree of belief or conviction in the valuation and a willingness to act. So what are some takeaways from all this? Well, first off, you want to focus on companies with high return on invested capital, with limited reinvestment, that are essentially wealth machines. Warren Buffett refers to them as consumer monopolies or equity bonds. What are the characteristics of these wealth machines? In his book, Narrative and Numbers, Aswath Damodaran identifies that companies are in one of four phases of life, either early life, midlife, mature life, or approaching end of life, which is similar to what is being shown here in the picture in the upper left-hand corner. Damodaran identifies the type of CEO best suited for each phase. In early life is Steve the storyteller. In midlife, it's Bob the builder. In mature life, it's Don the defender. And end of life, it's Larry the liquidator. Early life companies tend to grab the headline with spectacular claims about changing the world, often referred to as disruptors. A recent example is the pending IPO of Elon Musk's company SpaceX. The company is selling over 500 million shares to raise $75 billion. The offering values the aerospace and artificial intelligence company at $1.75 trillion. This will be the largest stock market IPO in history. The picture in the upper left corner is from the book The Gorilla Game by Jeffrey Moore. The book is mainly about early life companies. He talks about the chasm early life companies must cross in order to reach a broader market. Most early life companies don't survive the chasm. Those who do enter what he calls the bowling alley, where market forces quickly coalesce around a few dominant winners, what he calls gorillas. The fish model on the top right depicts a mature company transitioning to a new market. Their existing revenue drops as their costs balloon. Sacrificing profits to grow market share is a classic characteristic of companies competing in the bowling alley. Picking eventual gorillas in a developing market is highly speculative. Startups typically are funded privately by savvy venture capital firms or angel investors. Startups are increasingly kept private until the initial investors are ready to liquidate. By the time the startups go public, their early explosive growth is subsiding. End-of-life companies are typically desperately trying to transition to growing markets. Similar to early life companies, they must cross the chasm and compete in the bowling alley. Few survive, making them extremely speculative. Charlie Munger, the famed partner of Warren Buffett, had what he called the too hard pile that he avoided. He would rather focus his efforts on businesses with proven track records. This is sound investment advice. It is best to do evidence-based investing, focusing on companies with proven track records, namely midlife and mature life companies. One place to find these kind of companies sources is simply looking at the list of companies that are included in the S&P 500 index. Another source is the companies that have historically provided the majority of wealth gains. They have a proven track record. Looking at the top 50 companies on the index, you see well-known names like Walmart. Walmart is currently the 12th largest company with a market cap approaching $1 trillion. Entering Walmart's stock ticker into the valuation worksheet, you get a valuation of $117.30 using the default inputs. This is similar to the current price of $119.88. Mid or mature life companies typically have relatively stable operations. Polaris categorizes companies as either stable or dynamic. Walmart's operations are currently being categorized as dynamic, as shown in cell AD3. Polaris categorizes a company's operations as dynamic if they have recently reported negative earnings, or their capital structure is changing, or have relatively large R&D expenses, or currently have a high PE ratio. Walmart currently has a very high PE ratio of 42.2. This implies the market is expecting significant growth. When using the valuation worksheet, it is recommended to start with the default inputs for Stage 1 and Stage 2 in column AF. Stage 2 default should typically be used. Stage 2 return on invested capital defaults to the Stage 2 weighted average cost of capital. And growth defaults to the forecasted growth of the economy, estimated by the risk-free rate. Stage 2 reinvestment rate is calculated using the return on invested capital and growth. The calculated reinvestment rate should be compared to the value in cell AE10 to ensure it's reasonable. Stage 1 default return on invested capital should typically be used. Not having to enter a return on invested capital is a major advantage of the valuation worksheet being return on investment capital based. It is recommended that only the Stage 1 growth be entered by the user. The following has been added since the video was originally recorded to assist in setting Stage 1 growth and possibly overriding the return on invested capital. The chart appearing in the June 2026 issue of the American Association of Individual Investors has been added to the valuation discounted flow worksheet. The chart was created by Brian Hoffey, a certified financial analyst. The chart shows typical ranges of growth and return on invested capital for various business qualities. Hoffey characterizes a company's business quality by the strength of its moat, also known as sustainable competitive advantage. Recall, wealth machines were discussed earlier in the video. In Hoffey's chart, wealth machines are strong compounders or exceptional franchises. It is suggested you align the Stage 1 default return on invested capital with the range of sustained return on invested capitals in the chart to determine the business quality, also known as moat. Consider if it is reasonable to associate your company with the representative companies in the chart. Once you have classified your company's moat as weak, moderate, strong, or exceptional, consider the growth range in the chart for that classification. Notice the growth rate is roughly half the sustained return on invested capital. Also, keep in mind that an average company grows around 7%. Use your insight about the company to choose a growth within the range listed in the chart. Try growth values around your chosen value to get a range of valuations. Okay, back to the original video. Stage 1 reinvestment is calculated using the return on invested capital and growth. Recall, amount of reinvestment is difficult to forecast, so best to let it be calculated. As discussed in the discounted cash flow video around the 10-minute mark, in the return on investment capital based valuation worksheet, sales grows at the same rate as net operating income after taxes, causing the operating margin to stay constant. A constant operating margin is a reasonable assumption for a stable company. Since the growth of sales equals the growth of net operating income after taxes, forecasted growth of sales can be used as a proxy for net operating income after taxes growth. Forecasting is difficult, but top-line sales growth is easier to forecast. It usually involves forecasting the total addressable market, TAM, and the likely percent the company will garner. A good starting growth is to enter the growth that causes the valuation to be close to the current market price. This gives you an idea of the consensus growth implied by the market price. Next, enter your forecasted growth. To ground your forecast, use evidence from the past. Today, historical data is extremely easy to retrieve, particularly using artificial intelligence like ChatGPT or Claude. This valuation is referred to as the theoretical valuation. It is a different concept from the theoretical model type entered in cell H91. If there is a large difference between your valuation and the current market price, you should not just assume you are right and the market is wrong. John Maynard Keynes, famed economist, said, "It is not sensible to pay $25 based on a valuation of $30 if the current price is $20. He advocated factoring current price into a valuation. So you should compare your forecasted growth to that assumed by the market. Consider the extent the market may be willing to change their collective growth assessment towards yours." Keep in mind that the typical sales growth for a stable company is around 7%. Enter the likely market reassessed growth rate. The resulting valuation is referred to as practical valuation. It is a different concept from the practical mode type entered in cell H91. Practical valuation should be used to make trading decisions, not the theoretical valuation. Market prices drift from the valuation because relatively few investors are methodical that base their decisions on thoughtful valuation. It is estimated that over 80% of daily trading is done by mechanical and maniacal investors. Mechanical investors, like pension funds and indexes, abide by strict trading rules. Maniacal traders, like day traders, base their trading decisions on price action, called technical analysis, and are often fueled by emotion. The daily price of a stock is typically driven by 0.5% of outstanding shares being traded. This means 99.5% of shares are not traded on a daily basis. On a given day, few traders determine the price. Notice the valuation of Walmart is fairly close to the current market price by just using the default input values. This is often not the case. Using the default input values for Caterpillar, you get a valuation that is quite different than the current market price. Claude shows sporadic growth over the last several years, making forecasting the future speculative. Damodaran does not consider this a failure of the model, rather the nature of the stock, namely it's simply hard to value. As mentioned earlier, Charlie Munger had what he called the too hard pile that he avoided. It is recommended you do the same and focus on stocks that are compatible with the model. In 1955, while testifying in front of the Banking and Commerce Congressional hearing, Benjamin Graham said, "We know from experience that the market eventually catches up with value. It realizes it one way or another." A contemporary interpretation of his statement is mean reversion, shown here in the upper right corner. Many people think mean reversion implies an outcome gradually returns to its historical average. This is not accurate. Mean reversion is about the average over numerous observations. The more observations, the more the average of those observations tend towards the long-term historical mean. For example, a single coin toss swings from one extreme to the other. But when multiple coin tosses are performed, the average of those coin tosses is similar for each group of multiple coin tosses. Individual coin tosses continue to swing between extremes, but the average result increasingly tends towards a common average as the number of tosses in each group increases. In the stock market, this is like owning a stock for a day versus longer. Each day the stock price moves sporadically, but the average over the long term tends towards a common average. As the graph on the left shows, market prices swing sporadically, but over the long term, they tend toward a common average. As Benjamin Graham stated, over the long term, the market eventually catches up to value. Value is like gravity, constantly pulling the market towards it. An investor must have conviction in their valuation in order to ride through price swings. An investor needs to have the confidence to size a position meaningfully and hold it through volatility. Famed investor Warren Buffett has seen his Berkshire Hathaway stock halved several times over the decades. His net worth has gone from $2 billion at age 60 to over $70 billion by age 80. A testimony to the cumulative power of conviction. In Adam Smith's book Wealth of Nations, he mentions the concept of the invisible hand. It's when competitive markets aggregate self-interested individual decisions in a way that unintentionally produces collective good. More generally, it is known as emergent phenomena, which is when individual components interact, causing something unforeseen to emerge. The whole is different than the sum of the parts. In closing, remember the words of behavioral economist Daniel Kahneman. People are neither rational or irrational. They are simply human. People create their own worldview from which they make decisions. Okay, that's it. Thanks for watching.